Today, let's talk about the crucial topic of passive loss rules for those of you with rental properties who wonder how your rentals will affect your income taxes, especially when you incur big expenses related to your rentals. First off, what are passive loss rules? These rules often restrict the amount of losses you can claim from passive activities like rental properties or partnerships where your daily effort in the activity tends to be low. The IRS doesn't really want you using those big losses to offset your other income without following some pretty tricky rules, mainly aimed at slowing down the pace at which you can deduct those losses. Let's look at a couple of examples to see how these rules work. Let's say you just bought 2 rental properties in 2023, shown here on your Schedule E. The first rental property shows tenant receipts of $25,000, then various typical expenses, resulting in a net profit this year of $10,000. The second property has a lot of depreciation expense and high mortgage interest costs, so it didn't make any money in 2023. In fact, it lost $15,000, at least on paper. Here's where the first passive loss rule comes in. You made $10,000 in profit from rental number 1, but you lost $15,000 on rental number 2. The first rule says that you can deduct only $10,000 of the $15,000 loss this year, essentially only up to the amount of passive activity profits you made this year. Here, the IRS is starting to slow your roll. However, with the second rule, the IRS throws most rental landlords a bone. In most cases, small landlords with moderate incomes are eligible for the active participation exception. It simply means that you can deduct up to $25,000 in passive losses even if you have no passive income to offset. Active participation allows you to deduct more losses immediately rather than carrying them over until next year, and that's where rule number 3 comes in. Any losses that aren't allowed under the offset rule, Oregon under the active participation rule, don't just disappear. They just get suspended here on Form 8582 for use in later years when you have more passive profits, or until you sell the property altogether. So the passive loss rules don't permanently deny losses. They simply may postpone some of them until later, slowing you down a bit. After you've operated rental properties for a few years, those suspended losses may start to add up, all the while being tracked on your Form 8582. This is where rule number 4 comes in. Let's take another example. Here's your Schedule E for 2025, a few years later. The 2025 profit and loss for each property looks about the same, but you've been operating your rental now for a few years, and let's say rental number 2 has $50,000 of suspended losses from prior years. Next, let's say you sold rental number 2 in 2025 also. This is where rule number 4 comes in. On Schedule E for 2025, there's a new wrinkle. Since you sold your rental number 2 this year and it had $50,000 of built-up suspended losses from prior years, those losses now get released. That's right, they're set free from their captivity and can now be used to offset any other income you have in 2025. They're a glorious pent-up deduction just waiting to lower your tax bill. One thing to note, when you sell your rental in a 1031 tax-deferred exchange rather than an outright taxable sale, you may find that the IRS has slowed your roll again. Since you may not recognize any gain on your 1031 exchange, those old suspended losses continue to carry over to future years, but are now attached to the new replacement property, again subject to all the normal passive loss rules each year. This can get tricky even for tax pros, so ask us any 1031 questions you may have. So there you have it, most passive loss rules in a nutshell. Although we'll review your Schedule E with you each year, it helps a lot if you understand some of the basics too. Let us know if you have questions. Thanks for watching and being engaged in your own tax situation.